Good morning and welcome to our webinar on residence and domicile. I'm Helen Cuthbert and I'm a private client tax director here at Menzies. This webinar is being recorded and a link will be available to you all. There'll also be a Q&A session at the end. So please pose your queries in that Q&A function and we'll deal with those not as the webinar goes on, but at the end of the session. As a firm, we often advise individuals who are internationally mobile with multi-jurisdictional issues to consider. Our clients and prospects include those looking to move to the UK and those also looking to exit. For those arriving, we advise and assist to help them plan before arrival in the UK. This ensures that they are compliant with UK tax requirements from the time of arrival, and it also allows them to plan effectively so that they may bring funds to the UK in a tax-efficient manner. Our clients may be looking to reside in the UK for the short term, a work project, for the education of their children, for lifestyle reasons. We turn to the first slide then. Alternatively, individuals may be planning a long-term move to the UK. While we do not advise on immigration matters, we work closely with lawyers who specialise in this area and ensure the best solutions all round. We also advise individuals who wish to move out of the UK to take up residence abroad. This may be, again, for work purposes, family reasons, or to enjoy their retirement. As a result of the pandemic, many people have grown used, of course, to working remotely, and for some, this has given rise to a dream to live and work abroad. Perhaps growing concern about potential tax hikes at some points in the UK is another reason why individuals are considering upping sticks and heading for warmer, potentially more tax-efficient climes. However, when moving to another tax jurisdiction, there are some important practicalities to consider. Other issues might include applying for the right visas, taking steps to overcome language barriers, and putting in place arrangements for family and living. Often, individuals may make the decision to relocate overseas at a key milestone in their professional life, for example, at the time of a significant business transaction. As such, getting the timing of their move just right can make a huge difference to realising optimal value from the transaction. So the key concepts to consider for both those arriving and those leaving are residence and domicile. Each concept has a role to play, but they are distinct from each other and the impact upon differing elements of UK tax. So it's worth understanding the distinction between non-residence and non-domicile, which have different implications. Whilst a person's residency is the country in which they reside and pay tax upon year, an individual leaving the UK will remain UK domiciled unless they've completely severed ties with the UK. Domicile centres, therefore, upon long-term home, we generally follow the domicile of our father, and we'll talk about that a little bit more later on. So it therefore refers to where our homeland is. An individual who is domiciled and resident in the UK is subject to UK tax on their worldwide income and gains as they arise. In contrast, for an individual born overseas of non-UK parents, tax residence in the UK does not automatically mean that they now become UK dom. This non-domiciled status can be protected, and in doing so, the individual may benefit from certain UK income and capital gains tax exclusions. In addition, there are implications for inheritance tax here in the UK. While the worldwide assets of UK dom individuals are subject to UK inheritance tax, it's only the UK cited assets of a non-domicile that are subject to the tax. Individuals heading for a new tax jurisdiction should seek support from their key Menzies contact as early as possible in the process, and certainly before making the move overseas. This may involve seeking specialist support around how best to structure earnings, investments, and pensions. There may be complexities, as an individual may become tax resident in two different tax jurisdictions for a period of time. Clarity should be sought on how to report the position to the jurisdictions in question. Turning then to the idea of residence. As individuals move in or out of the UK, it's key to understand the timing. When will their residence in the UK commence? How do they sever their ties with the UK alternatively? How will their tax status change on a day-to-day basis? Over the next few slides, we're going to look through the statutory residence framework and then consider how presence in the UK will impact the individual, from the taxation of their business profits and employment income in the UK to the impact on their existing wealth and business structures. Next slide. The UK's framework is known as the Statutory Residence Test, or SRT. The rules are worked through on a step-by-step process to consider whether an individual is UK resident for a particular tax year or not. Once we have ascertained tax residency, we can then go on to consider how income and gains are charged to tax. For a non-resident, for instance, UK income tax is limited to UK source income only. So this slide is a pretty involved, busy slide. There's a lot going on. What I'm going to do is just talk you through it section by section. And the first half of the table, the top half, talks about those who are non-resident. So the SRT tends to focus on non-residents first, although in practice, what we would actually do is look initially at whether an individual is here in the UK for 183 days or more. If they are, they're resident and we stop there. Turning then to those who have a few days presence in the UK and may therefore be non-resident. Is the individual someone who has not been present and resident in the last 3 years? Have they spent less than 46 days in the UK this year? If so, they remain non-resident in the current tax year. For individuals who have been resident in recent years, and there we consider the test to be one of the previous 3 tax years, then the threshold of days drops to being less than 16 days in the UK in the current year. If 17 days are spent here, the individual becomes tax resident this year. Where individuals leave the UK to work under a full-time contract abroad, and they may remain present in the UK but for less than 91 days in the year, then they will also be non-resident. This test requires a contract with duties abroad, and for the days on which they do return to the UK, they must ensure that they do not work from the UK for more than 30 days of those 91 days. Bottom half of the table then, resident. Other than the 183-day test mentioned previously, an individual may alternatively be UK resident if they have a UK home. And key here is no overseas home or work full-time in the UK. This is referred to on the chart as working sufficient hours in the UK. Therefore, it's not simply a matter of just counting days to consider residence. Let's move on to the next slide. We will now consider a number of the key terms we've just encountered in the test. A day is counted as a UK day if the individual is here at midnight. There are situations where days are not counted, as there may be exceptional circumstances. For instance, ill health, war, a pandemic. Perhaps visiting the UK when a close relative falls gravely ill and passes away, resulting in your needing to stay in the UK for some unexpected days. There are a number of tribunal cases around this topic, and the reason must be beyond the taxpayer's control, that they are unable to leave the UK until the situation has perhaps stabilised, and that they did intend to leave the UK as soon as the circumstances permit. Being unable to leave the UK is currently seen by tribunal as going further than perhaps interpretation to date. For instance, being physically unable to leave the UK, or instead being morally unable to leave the UK. There will be plenty of cases that come out in years to come as a result of COVID. My advice is take specialist advice on the topic. The complexity of the rules notwithstanding, the UK tax system requires resident status to be self-assessed. It's therefore important that individuals maintain records to support their self-assessment should HMRC ever question their resident status. So what constitutes appropriate records? Well, it will vary from case to case, but could involve evidence of travel to and from the UK, records supporting particular working times and locations, and records showing how a particular property has been occupied. Working in the UK, labelled on the slide as UK work. To be considered a full-time worker in the UK, for the purposes of the test, The individual must, of course, work in the UK, although the period in which this work covers need only actually be for 1 day in the relevant tax year. The contract must cover a 365-day period, and they must spend 75% of their working time in the UK. Worth noting, the contract does not itself need to be with a UK employer. Again, a topic on which our clients generally need advice and help. Working abroad. For an individual to satisfy this test, they must work under a full-time contract, which averages 35 hours a week. Watch out for absences and holidays as they drag the average down and create breaks in the employment potentially. Again, the contract does not need to be with a non-UK employer. UK home. This is a test, again, that can trip people up. A UK property can render an individual UK resident if they spend time at that property on not least 30 days. Here, it's not midnights. So you could just be popping to the house for a few hours during the day, staying somewhere else, it still counts. This can be protected against by also having a non-UK home where the property is available to the individual for at least 91 days. Let's move on to the next slide. It's possible that an individual's resident status may remain undetermined through the resident and non-resident, the automatic tests and the SRT that we've just talked through. In which case, we turn to a combination of days and connection ties to determine status. This is known as the sufficient ties test. Again, it's a busy slide, there's a lot going on, but it can be narrowed down into considering leavers and arrivers. Worth noting before we go through, it's really important that you've managed to get through the automatic tests on the previous slides first before you can consider the sufficient ties test. So leavers, so outbound individuals, those leaving the UK are catered for on the right-hand side of the table. We look at whether they have a UK resident family, are doing substantive work in the UK, have accommodation available to them, spend 91 days here in the past 2 tax years, and finally, whether they spend more time in the UK than in any other single country in the year. UK resident family, it includes spouse or common law partner, children under 18. There are particular rules where those children are in boarding school, which we won't dwell on here, and the impact and status of one spouse can have an impact upon the other. Accessible accommodation. What we mean here is a home that's available for use. It may be an Airbnb, the home of a relative, having the keys to a parental home, for instance. It's the availability that provides the tie, not the actual usage, as long as they just spend 1 night there during the year in most instances. Substantive UK work. It includes employment and self-employment. 40 days is considered substantive, and the definition of a work day is actually just 3 hours or more. It includes reading emails, agreeing meetings, Teams calls, travel, etc. Once the ties are determined, the individual then considers how many days they've spent in the UK, or hopefully actually we look at it in advance, how many days they plan to spend here to determine residence. So for an individual with the work tie, accommodation tie, and the 91-day test from the previous 2 tax years, they'll be resident if they spend 46 days in the UK in the current tax year. If they drop 1 tie, and that can be managed in certain circumstances, they can spend up to 90 days in the UK without being tax resident. Arrivers, those arriving in the UK on the left-hand side of the table, have generally the same set of tests aside from the country test at the end, i.e. it's unimportant whether they spend more days in the UK than they do in any other single country. Turning to the next slide. General position for individuals for tax year is once you're resident for the entire tax year. There are special rules for the year of arrival and the year of departure, as the tax year can be split into a period of residence and one of non-residence. This means that although UK source income remains taxable throughout, for instance, non-UK income is only taxable if it's received in the UK part of the tax year. Capital gains realised outside the UK may also be protected although we would generally advise individuals to plan transactions and trigger significant gains in a year of complete non-residence. Key here is to consider that you only consider split year if the individual already triggers residence under the SRT test that we've seen so far. So who can benefit? Those leaving, there are 3 scenarios. Those arriving, 5 scenarios. I won't go through these in too much detail, but just to give you a flavour, for those arriving, it's those that are arriving with having been working full-time abroad, accompanying a partner in that instances, or for those leaving to live abroad. For those arriving, those returning from full-time work, those arriving and having a UK home. Separate to that is those only having a home in the UK, so selling up overseas or accompanying a partner. Let's move on to the next slide. Thus far, we've focused on the mechanics of residency. Are you in or are you out? There are planning opportunities for those who are non-UK domiciled. So let's go into a little bit more detail now. What does domicile mean and what does it affect? Domicile refers to an individual's long-term home. It's the country with which an individual has their closest ties, personal, family, social, economic. We're born with a domicile of origin, which tends to come from our father. We may acquire a domicile of dependency if our father's domicile changes in the years of our minority. Alternatively, we may shake off our domicile of origin in favour of a domicile of choice by moving and severing ties with our country of origin. The process of claiming a change in domicile status involves the individual stating that they've acquired a domicile of choice elsewhere and providing really strong evidence to support that claim. Their status may be reported to HMRC on their individual tax return, where relevant, yet the difficulty lies in that domicile is often not challenged until an individual has died and their estate position is reported to HMRC. It then rests with HMRC to challenge and analyse claims for non-domicile. Evidence of acquiring a domicile of choice outside the UK should involve regularly documenting future plans and following up on those intentions. An individual must be able to show that they intend to leave the UK and not return. The individual seeking to lose their UK dom will need to show strong and numerous links to their new jurisdiction, together with a severing of ties with the UK. A statement demonstrating their intentions and the steps taken at a given point in time can be invaluable in providing the necessary evidence to HMRC in years to come, perhaps for the family when defending the tax position taken by their late relative. It should be noted that a return to the UK for a formerly domiciled individual will revive their UK domicile of origin with the resultant tax consequences for income, capital gains, and inheritance tax. So what are those tax consequences? What's the impact of domicile on UK taxation? Income and capital gains taxes. Favourable tax treatment may be claimed by a non-UK resident, but a non-domiciled individual. This is known as the remittance basis. It allows only UK source income and gains to be taxed in the UK if non-UK income and gains remain outside the UK and are not remitted. There's a cost to the claim. For the first 7 years, this cost is limited to the loss of the personal allowance, which is sitting around 12,500 at the moment for income tax, and the 12,300 annual exemption for capital gains. For an individual earning over approximately 125k, the personal allowance is lost in any case, so that cost might be something that's just not relevant. After 7 years, however, it gets costly. There's an annual charge to pay, 30,000 after year 7, rising to 60,000 after 12 years. Planning should be taken by non-doms who intend to use the remittance basis, and advice is required, and in the ideal world, this advice and planning should take place pre-arrival. That said, we regularly advise people who've already come to the UK on how to amend and maybe clean up assets and wealth that's overseas. In addition, as mentioned above, an individual who is non-dom is not subject to UK inheritance tax on their non-UK assets. Non-dom status used to be available for individuals no matter the length of time they'd spent in the UK. It's now limited to 15 years. Therefore, after 15 years, an individual is deemed to be domiciled in the UK for tax purposes. That said, the general domicile, the general position under general law for domicile can change. So the longer someone stays here, the more likely that their domicile position needs to be looked at and advised on to check that they're not actually acquiring a domicile of choice in the UK. Let's move to the next slide. We're now going to focus on what individuals should consider before moving to the UK. So the first step, as we've been through already, is to determine residency, preferably in advance, so that the trigger date is known. This may include a claim for split year treatment. Register for self-assessment with HMRC. Watch the overseas rules too. Residence can be triggered and maintained in two jurisdictions. Therefore, key is to check the double tax treaty between the countries, if there is one, to see who has the taxing rights and whether credits will need to be claimed where income or gains are taxed twice. Where the individual is a non-dom, consider whether some pre-arrival planning should be undertaken. This can involve accelerating income or gains before UK residency is triggered. Non-doms may wish to segregate their separate sources of income and gains once they become UK resident, and this should ideally be planned for in advance. The remittance of non-UK funds into the UK will not always trigger a UK tax charge dependent upon the source. For instance, pre-arrival receipts may be remitted tax-free as long as they're not mixed with funds that are received after UK arrival. Gifts made outside the UK may likewise be tax-free when remitted. Therefore, segregation is key to minimising the tax charge in the UK on a later remittance, and this requires offshore bank account structuring, which is maintained annually. The experience tells us that individuals should plan as far as possible for the funding of their UK expenditure, and often perhaps plan for double the requirements in terms of cash in having available to be segregated that they can call on once they're in the UK. The offshore funds that are received after UK residence is triggered may be spent overseas without triggering a UK tax charge, and clearly that's beneficial overall. Certain individuals may consider protecting their overseas wealth and assets through trust structures outside the UK before arrival, or perhaps before becoming deemed domicile in the UK. So remember, that's after 15 years. This can have, for certain individuals, income tax, capital gains tax, and inheritance tax benefits. Should we run the poll now? So some additional information questions, some opportunities to pose some questions of things that you might want more information on. Okay, let's move to the next slide. To highlight then, a few key thoughts for those arriving in the UK with existing businesses and employment arrangements or directorships in place. A UK resident employee may bring with them a payroll obligation here in the UK. This is the case where the employee triggers the employer to have a taxable presence in the UK. Monthly payroll will need to be operated either by the employer or actually in certain circumstances by the individual themselves. It does not have to be the case that we have a company that's required to pay corporation tax on its profits here in the UK. It can be enough that a taxable presence exists, which tends to be seen as an office, branch, or agency in the UK. So if in doubt, seek advice. The next step is to consider whether the company for whom the individual works has a permanent establishment in the UK as a result of the move to the UK. Key to this is whether the individual in the UK has a value-added role in the business. If so, there's a risk that an element of the profits may be taxable in the UK. Again, if in doubt, seek advice. Finally, does the move to the UK pull the non-UK registered company into the UK tax net with its worldwide profits subject to UK corporation tax? This is dependent upon the management and control of the company. Where are those central management decisions made? If that's the UK, then the company is at risk of becoming UK tax resident. Okay, so final points before we wrap up and to answer a few of the questions posed in advance. Risks for leavers. We have some temporary non-residence rules. They're fairly nasty anti-avoidance rules that catch income and gains for individuals who leave the UK temporarily, which is generally 5 to 6 tax years. In that instance, there can be a tax charge on re-entry to the UK. So again, something really to seek advice on before going and to keep in touch while they're outside the UK ahead of a move back to the UK. Those wishing to leave the UK and relinquish UK tax residence should really plan ahead, particularly individuals who've been working in the UK full time, but are intending to reduce their working hours abroad. There's a risk the individual would be UK tax resident despite spending most of the tax year abroad. For those wanting to fall into the sufficient ties test, watch the individual doesn't fall within any of the UK automatic tests first. This means ensuring that they have at least one other home outside the UK and at least 30 days are spent there in the tax year, and they're not working in the UK full time. A couple of other questions posed in advance. US, UK spouses take advice. The US hold on to their taxpayers, and it's important to consider tax credits across the 2 jurisdictions when moving from one to the other, particularly if you've got kind of mixed spouses in terms of status. Also, ensure wills are written in each jurisdiction to cover the various assets that are held. Employment contract, where and with whom? It's the residency of the individual that actually tends to drive the tax position rather than perhaps who the contract is with. Where the duties are performed, that's key. And again, seek advice, preferably before those contracts are drawn up. Okay, so if you've got any questions, pose those questions in the Q&A section function. Okay, so one question there. If there's no work, only retirement abroad and retirement income, so pension, investments, etc., how does that affect? So as you move abroad, you'd need to make sure that you fall into either one of the automatic non-UK resident tests, or that you fall into sufficient ties and connection factors and are spending a low number of days in the UK to make sure you don't trigger residence. One key thing is to look at the treaty, if there is one, which can work in various different ways, depending on what jurisdiction we've got, as to how the pension income should be taxed, lump sums, etc. So again, specific advice needed. If you don't pay the remittance basis, that's another question that's come through. If you don't pay the remittance basis, so if you're taxed on a worldwide basis, I think is the question there, are you taxed on earned income in the UK? You're always going to be taxed on earned income in the UK because it's UK source income. It's your offshore income that can be protected by the remittance basis. How does one remit clean capital? Literally just to transfer into the UK. Key is making sure that it is clean capital and hasn't been tainted by any gains, any proceeds, any interest that's been received offshore. So really key to keep segregated accounts. Just one point there about remittance. The definition of a remittance is really wide. So we can have specific remittances where you transfer funds from one account to another. You can also have constructive remittances, which is where you pay for goods and services that are enjoyed in the UK and you pay for those with an offshore source of funds. Last question up on the Q&A. Is it generally better to be planned to be taxed in the UK rather than abroad? It's very difficult to give a concrete answer on that because every situation is different and it depends upon the different sources of income and the different sources of gain, I'm afraid. Next question. If you're a UK resident now on a working visa from the US, what's the best way to find legal help on determining tax and will issues? Tax advice plus legal advice, and make sure that the two hone in together. So we can always work with lawyers, either a lawyer of your own choice or one that perhaps we have a connection with from previous work and relationships. So make sure the two work together. But particularly in terms of visas, making sure that those immigration issues are dealt with by an appropriate lawyer. Does one have to report clean capital remitted? In certain circumstances, we would say that it's good to make a disclosure note to HMRC to self-assess that you are remitting and it's from clean capital. It can stop any of those questions coming up in the future and can preempt any inquiry or aspect inquiry that comes out. So take bespoke advice on that point. Okay, I think final one. If you live overseas and have a job overseas for a non-UK company, if you come to visit the UK and whilst visiting work remotely, does that count as UK work? It can do. So that's where we'd need to look at whether you've got sufficient work time in the UK under the automatic UK test or under the sufficient ties test, substantive UK work. So that's where those definitions come into place. Okay, and if you're not paying the remittance basis charge, so if you're not electing to be taxed on the remittance basis, you're instead taxable on your worldwide income and gains, then so if you're a non-dom, you're taxed just as I would be, who's a UK dom, and I'm a UK resident, you're taxed on your worldwide income and gains if you're not electing for the remittance basis. Okay, let's wrap up then. I think that's the end of our questions. Of course, get in touch if anything comes to mind after the webinar comes to a close. And just a reminder that everything's recorded, so you will shortly receive a link so that you can go back and look in as you need to. Thanks ever so much.